Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw, and joined here once again is Dan Mickelon. Seth's off this week, and he'll be back with us next week. And boy, we got quite a show for you guys today. I'm excited about kind of some of the conversation around the market and the topics. But there's a lot of our listeners that have questions. And before we get started, if you do, you can reach us at 855-226-8551, or you can email us at info@yourmoneyontap.com. We're all planners and partners here at Brayshaw Financial Group, and it is our goal to help you really find success in your investments. And we do three-dimensional investing, and I think that's the piece that makes us different. And today we're going to talk a little bit about one of those sectors in that area, in that space of the market. Today's show is this a bull rally in a bear market? That's the big question. What do you think, Dan?
I think it certainly has the indications of that. But as we kind of dove into a little bit of research to get prepared for the show here, there's some markers that we've kind of hit and surpassed that history would tell us no, that we may have in fact entered a new bull market.
That's scary. I mean,
yeah.
That's scary. There's just so much craziness going on, and there's a lot of speculation and concern. And we actually don't agree entirely on some of the stuff and the things that we're chatting about. So it's kind of like these are the internal discussions that we have. So this show comes in an opportune time. So maybe we'll come to a common feeling at the end of this. Who knows? But for all of you who are investing, one of the biggest concerns is really understanding your portfolio. And many, many people who are listening are looking and staring in the face retirement, and how am I going to accomplish this through the craziness of this market? Because, one of the things that I think we both agree on is the volatility of the market, the up and down swings is here to stay for a while. I mean, until the Fed and the market and the economy and the political environment and the global economic, scenarios that are happening, there's just so much unknown that any one thing that happens seems to sway the market in a very violent, very turbulent manner. And that makes income in retirement extremely vulnerable and difficult to manage.
Yeah, I mean, I think, unfortunately, I guess would be the word, but, the market is just reflecting society and the world we're in as a whole, right? These are just volatile times. Things are up and down, and, what would typically be a shocking day in the market has become routine, just like headlines that used to shock you are just about everyday events now in the world at large, not just the markets. So I think one conclusion, whichever direction you think the market's headed from here, as planners and as advisors, when it comes to building a sound retirement-based portfolio, some of the things that I know we agree on is how to best put some protection around the assets you have.
Yeah. And I think that is not limited to any particular one investment, but, building a solid foundation in your portfolio, understanding your vulnerabilities, your risks, all the things that involve the complexities of really having a healthy financial picture in place is really how you start out, to do this well. I think the person who's, wow, I just lost 20% in the market and it's recovering and I've recovered some, but I'm not nearly where I was. If that's a light bulb concern for you, that's when you reach out and you get some help, and that's where you can get a hold of us. But before we get into the heart of the show, we have our time where we spend time in the news, and that's this time right now for Money in the News.
And first we have here from an article from investors.com. Warren Buffett finally throws in the towel on 4 lousy stocks. And this is from Matt Krantz. And it's interesting. I mean, there's a couple of names that we kind of gravitate towards for this part of the show. I mean, I don't know, a show goes by that we don't talk about Buffett or Musk or Bezos or one of these guys, right? But, they're big names. And
one liberal after another.
there are names that just draw so much attention. Although I think Musk has kind of turned the corner on
Yeah,
that
no,
a
I think
little
he's
bit.
turned a corner a little bit. Yeah, I know.
See how this Twitter thing goes.
It's a slow corner, Dan, in my opinion.
But anyway, this was funny to me because we've done a bunch of quick hit topics on Buffett before, and one of the things that was kind of a methodology he claims to live by was never sell a stock. Right?
I know, right?
He never.
We
sells.
did a whole show on how he
Yeah.
never sells a stock at a loss,
And lo and behold, he's selling now. But
breaking his rules.
So there's 4 stocks that he quit. That's Verizon, Store Capital, General Motors, and U.S. Bancorp. So that was the interesting part to me. Why any one of those as a company chose to bail out of was less interesting to me. But the fact that he's kind of changed his methodology here a little bit and is come to the conclusion it is time to throw in the towel every once in a while. I found that to be interesting.
Well, a lot of perspective is around age. I mean, I think, and I'm speculating, but he sold a bunch of the airline stocks during the crash, and then sold them, and then lent them money under the bonds at 8, 9, 10%. So that was interesting. But when you're 40 or 50 years old and you're in the business for the rest of your life, like there's still a lot of time, and I can hang on to anything forever. When you're 80 some odd years old and you're like, I'm done with this. Like I want to I want to see some profit before I'm out of here. Might change the perspective. And I think that time horizon, it's true for Warren Buffett as much as it is for anybody else in the world.
I think as we all get older, we get a little less in the patience, right? So I think that just comes with aging.
I think the really interesting piece is that, I have been a long mover on the Oxy holding, like Occidental Petroleum, and he's been buying that. Now owns this article goes into owning 20% of the company now, and Occidental had bought a bunch of the oil shale, in the U.S. and one of the largest holdings out there. So that's an interesting scenario, and that actually, if you know anything about shale oil, it's the idea that it's significantly more expensive to extract than just a oil well. And so therefore a higher price of oil is needed to make that financially feasible. So it's interesting to me that he must have a long perspective on a high value, dollar value of oil in that scenario. But they do have a corner on that market, and he owns a significant portion of Occidental Petroleum. And I think it would be interesting too when Oxy really opens up their dividend again, what that stock's really going to do, because it's trading at the mid, I think, 60s right now, and that's interesting. I find that to be unique. But I think the other piece that this article brings out is that he owns like 894,000 shares of Apple.
Yeah, 6% of the company, which is, I thought, a staggering number. 20% of Oxy is one thing, but 6% of Apple is a whole different story. I mean, that's a
$2 billion company,
significantly larger entity there. But
I own 6.5%. 6.5
shares, right? But his fund has done okay, right? So this year the S&P's down 10% as we stand roughly for the year, and Berkshire Hathaway is still up 2.5%.
Yeah,
so not bad, considering what's going on, and that they took a $40 billion loss in the second quarter, which was obviously substantial. But this fund is absolutely massive, so they can handle that.
All right, next up. This is an interesting one, and I found this quite humorous, as I do most CNN stuff. This is from CNN Business. It says, it's like Airbnb, but for renting your pool to strangers. Things don't always go as planned. This is from Sarah Ashley O'Brien from CNN Business, as I mentioned. So this article is really hilarious. So this guy, Chris, which they don't disclose his last name, was surprised when some woman pulled up to his house and asked if he could move his car because she believed she booked his pool for the night to rent. And it's called Swimply. Dan?
Yeah, I think this actually came up in a prior show. We was chatting about this as kind of a side hustle deal.
Seth was bringing this up.
Yeah. Some way to make money on the side during the pandemic, or as things are kind of getting tight with inflation. The whole notion of renting your pool, which I have an above ground pool in the backyard, and I'd never thought of it until this came up, and after reading this, I probably won't do it. But yeah, it's a kind of an interesting idea, interesting model, a lot like Airbnb. The way it works is that the pool owner can set their own rate, whatever it is that they want to rent it out for. They can determine their own rules and hours and capacity and all those things. And it's a 15% cut that goes back to the company.
It's pretty
reasonable.
Yeah, pretty reasonable. It was funny because there was other people that started pulling up after this lady, so I guess she was holding a real pool party.
Yeah.
But I can see there being a business for that. Like, hey, I want to hold a pool party for my kid's birthday, and I need a place to set up a cake and a table and whatever, and I just don't want to, I don't want to go to, the town pool or whatever.
Yeah, I mean, with the summer we've had, I mean, scorching hot, right? So I think this would have been big business. But the article dives into some of the concerns around, who's liable for it, right? There's some liability going on there. And to date, fingers crossed, hopefully never the case, but nobody's drowned in any of these events. But
you definitely have to let your insurance provider know you're renting out your pool. I mean,
I can't imagine how you'd be covered if you go into commercial enterprise, with this, the pool in the backyard. But so there's definitely some issues there to be concerned with if you go this way. And as well, a number of people that they reference in the article, had one guy had some plants stolen, someone else had the stairs broken, going into the pool. So I think you can kind of imagine there's some shenanigans going on with some of these rented parties.
Yeah, I think there's a little bit of liability to say the least here. But I will tell you that some of the pictures in this article are
beautiful pools.
I mean, I would probably rent the pool.
Yeah, absolutely. That's a great idea. I mean, if you have a kind of a private backyard, a nice pool, and you're not in it every day. I mean, that's one of the issues I have is the pool takes so much maintenance and work, and for the handful of times you're actually in it, a lot of debate on how worth it is to actually maintain this thing. But if you can make a little money off of it, that changes the picture a little bit.
Yeah. Well, the next article we have here is Bed Bath & Beyond. Stock is up more than 300% in August as meme crowd cheers. Well, we talked about AMC way back when, the meme world got a hold of it. And Bed Bath & Beyond. I was in Bed Bath & Beyond like 3 or 4 months ago in the store in Concord, and I was walking through with my wife. And I was like, there was literally only 1 or 2 other people in the entire store. And that's one of the things. There's not a lot of traffic. There's not a lot of interest. Bed Bath & Beyond's tried to privatize the name of different things to make things more affordable and make more money. But the company has just not been doing well, closing stores and trying to, raise cash. And that has not been good. But the stock was, a few weeks ago, it was $5 a share, and it was super, super low. Today, it's trading in the high 20s. And it's absolutely crazy that this has, just taken off. And they're talking about it in the marketplace, and people are buying it. And, what's happened is there's a number of people out there that are shorting the stock. It's shorted close to 50%. So 50% of people are literally already sold their shares and are hoping it goes down. And
that's the problem is that they sold somebody else's shares.
Yes.
Right. So they sold shares that they didn't own.
Yeah.
On the hope that they'd be able to replace them at a lower price someday in the future, which is that's a short squeeze. That's selling short. It's just a style of trading that we've spoken about, but not one that we really advocate for here. Or personally, I don't really delve into it myself. I don't know if you ever short stocks, but
no comment.
But the the risk that these short sellers have found themselves in is very similar to what happened with GameStop and AMC and a handful of other companies this year.
If nobody's selling their shares, there's nothing to buy back lower.
You can't do it. There's only a certain amount of shares that exist, right? And when institutions own them and aren't selling them, and you find yourself on the wrong end of the short squeeze, you have to pay whatever it is, whatever the price is to fill that gap. So. This is one of those crazy trends that came out of the whole pandemic era and this Reddit Wall Street Bets page, which has gotten a lot of publicity lately, and it's kind of a forum people go to talk about investing. But they really rally kind of the small guy, the individual investor, around these situations where they happen to recognize, and there's different ways to find this out on the internet. It's not terribly hard to do, but they find a company who's 30-40% sold short. And then just buy it in mass. Just have everyone just begin cramming money into this thing. Buy it.
It was interesting about GameStop because all of these computer guys, these gamers, all this stuff, they didn't want it to go out of business. So it all started with the idea of like, how do we save GameStop? And they were like, everybody buy one share, And so buying one share was one of those things that, led to everybody buying a share. Now all of a sudden they're just, don't ever sell it.
Hold it till the bitter end.
Yeah, hold it to the bitter end, and then there was nobody to buy it to replace their shares, and that stock has still just kind of gone all over the place. It's
I mean, it's way down from its highs, though. Some people definitely got a hold in the bag there.
Yeah.
But what I found was interesting in this article too, this is kind of anecdotal, but I thought it was pretty cool, is we talked about before when AMC had all this massive influx of cash, and their CEO knew right away that it's got nothing to do with his actual business, and he knew it wasn't, his performance going forward was unlikely to match this valuation. So he took a bunch of the money and he bought a gold mine, right?
Yeah, right.
So what's interesting in reading this Bed Bath & Beyond article is that the CEO of GameStop himself,
I know,
actually just went out and spent, what did he buy? 1.6 million shares, or call options on 1.6 million shares of Bed Bath & Beyond. So he's recognized
with strike prices between $60 and $80,
which is 3 times where it is right now.
Which is scary as you can possibly believe.
So those are super cheap options, I'm sure. So he's in a position to make a ton of money.
Well, he already has.
Yeah, right.
He already has. It's halfway there.
So it's interesting that these guys who, found this newfound wealth for no reason having anything to do with their job performance, they're like, well, I'll take that ride again.
They're hanging their hats on a bunch of kids out there trading. And what's funny is Robinhood, the trading platform, they shut down the trading. I mean, the trading's been halted a few times on Bed Bath & Beyond, but Robinhood stopped the buying of it. I'm like, I don't understand. What does it matter?
That app just finds itself in trouble all the time.
Just get out of the way.
Interesting times, though. I mean, this is the stuff in the investing world that, it's kind of cool to witness. I would never advise anybody to get involved in any of it because none of it technically makes sense, but these people keep making money.
Well, the other thing is, I mean, the one piece about, the one good outcome of this, not particularly for Bed Bath & Beyond, but for AMC, was that, they were struggling to get, notes and loans from the banks because they couldn't really prove, an economical scenario that was viable to do a banking effort on a bunch of movie theaters that no one was going to, right? That was a big problem. So even though these Reddit kids were, trying to really just make some money and, stop these guys from shorting, AMC stepped in and started selling more shares at these outrageous prices, and they made their own loan.
Yeah.
And that's where they got all that extra money to buy a gold mine of all things, Yeah,
it's good. I mean, that is a part of this that I do enjoy, is that some of these CEOs, they see their stock skyrocketing and they understand that it's not fundamentally based on anything.
Right.
So on behalf of their shareholders, their actual, tried and true long-term shareholders,
right,
they're making the right move and trying to.
They did, and they saved the company. They saved the real shareholders' investments. I mean, and I think I was looking at AMC today. It's at $22 a share still. It was down at 10 and it bounced all the way back up. But that saved that company, and that was one huge outcome that these kids did. They saved GameStop too.
And it's kind of rooting for the small guy, right? But I'd like seeing AMC survive and some hedge fund go under. You know?
No, absolutely. I think we all do. And Bed Bath & Beyond, though, I mean, they got a long road to haul before they figure out a better business model.
Still not a good company.
No. Still not changing my life. All right. Well, that's going to do it for Money in the News. We will be right back. Don't go anywhere. We're talking about, is this a bull rally in a bear market? That's a big question mark for everyone out there. And it's all over CNBC and Fox Business. They are driving home whether or not they have one commentator after another on there trying to fight through the fundamental analysis here of what's going on. If you're fighting through that too, give us a call, 855-226-8551, or you can email us at info@yourmoneyontap.com. We will be right back.
If you're listening today and, your questions are outside the box of estate planning or financial planning or any number of the pieces that we kind of traditionally talk about, don't forget that Brayshaw Financial offers auto, home, and business insurance. And we have an entire department that handles all of that for you. Give us a call at 855-226-8551 and be happy to take care of those needs for you. Or email us at info@yourmoneyontap.com.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben and Dan.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw, and I'm joined here once again with Dan Michelon. As I mentioned, Seth is off this week, and we hope he's having a good time, which we did not wish to Dan last week. I don't think Dan heard the show last week. It was kind of brutal to Dan, his vacation time, but
Yes, it was a rough vacation.
it was a rough vacation, so now I feel guilty. But anyways, you can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And today we have a topic that is on everyone's lips, which is this a bull rally in a bear market? Are we recovering? Are we heading to new highs? Are we surpassing it? Where is this market going? There is so much data, so much information. I mean, Dan, we watch financial news all day long. It's always on in every office, every room, everywhere. And, I listen to all the commentators and the commentators of the commentators and their guests of their commentators, and there's just so many moving parts going on. And I think what is making this so complex, and we're going to go over this today, is that there's all these different fundamental, market technical analysis pieces that drive conversation around whether you're in a bear or in a bull and when things change. But the problem is things are starting to happen that have never happened in any of these, scenarios that have been, never, there's just line items that have just never been one way or another without it being a bear or a bull. And now we have opposing things falling apart, and one's going to be right and one's going to be wrong.
Yeah, I think we've all seen over the last, even 8 or 10 years, some assumed to be tried and true, market analysis things in terms of, predictable trends just haven't proven to be true. And we find ourselves in another situation here where kind of opposing ends of the story. And to your point about watching the news, I think they literally line people up like, this is a bull, this is a bear, this is a bull. So they keep you guessing the whole time because there's no consensus in any of this stuff. So it's kind of funny watching them argue about it round and round. But, it's our job to decipher our way through that and come to a conclusion that we can build portfolios around and literally, bet money on, right? And we're investing the money in trying to predict which of these trends is going to prove to be the one that occurs today or in this next short period of time. But there is for sure one thing that we know is going to happen is that one of these major historical trends about analyzing what's happening right now is going to be broken.
And that's really scary because that's going to change a lot of, data and management around that and how people look at the market moving forward. And, they're going to start looking for new trends that seem to be, unbroken as their thing. Or they'll say, hey, well, only one other time this didn't happen. It will be the next phrase because we hear that a lot. Well, it's every time but one.
Except this time.
Yeah. And so that makes it complicated. There's a lot of really simplistic things inside our world that we kind of all intrinsically know, right? I mean, we all know that there's, 4 higher signs everywhere. Everyone's looking to hire. We're looking to hire. So everyone's looking to hire. So that's an interesting scenario. And then the other piece about it is that, interest rates are going up. So the cost of a mortgage is higher, which usually drives down, building of homes. But inflation in the cost of everything is higher and wages are higher. So, there's these kind of, things that could potentially turn out to be neutral if everyone's making more and everything costs more. Maybe the cost of living is the same, right? And then that's a question mark. But the fact that there's so many for hire signs across everywhere, everybody I talk to is hiring. They can't find enough help. So that's a very interesting dynamic. And I think, we're going to talk a little bit about why that is the case and, how that's impacting, the market around us. But the Fed is right around the corner talking about raising rates, and they're doing, I was watching CNBC today, and they were talking about, whether it's going to 60 to 50%, whether or not it's going to be a 50 or 75 basis point hike. But we all know they're raising rates. And, that's going to obviously impact in a big way the cost of everything again.
Yeah, I mean, whatever effect that the Fed is hoping to have with inflation doesn't really seem to be sticking. I mean, the price of gas has come down. I mean, that's one thing that's positive that we've noticed. But, everything else continues to be very pricey.
But it's down. It's down.
Still high, but down, right?
But it's still up. Right. It's down from being up, and it's still up from being down. So, that creates a lot of complication. I mean, I know for a fact that people are basing jobs that they take based on how far it is away.
Yeah,
I've talked to people.
Yeah, commutes come back into play. It's a big question now as well. How much time and money is going to be exhausted just trying to get to work? So, yeah, certainly it's confusing times and complicated times. But, trying to get a hold of these trends is what we do here at Brayshaw Financial. So, the question comes back to is are we in a bull rally in a bear market, meaning that, this last couple of weeks of strong performance is likely to recede and potentially reach a new low? Or are we at the front end of a whole new bull market? And we just went through the fastest bear market in history.
Yeah, exactly. I mean, I think that's one of the things that exists out there. Today, we're going to talk a lot about a couple of different scenarios of things that have happened and what a bull and a bear is. And then we're going to give you some real tangible ways to look at investing moving forward and how to try to amplify your portfolio, maybe what to do. I mean, maybe your portfolio has recovered a little bit. We've seen about little bit more than half of the recovery occur of the initial loss. So we're going to talk a little bit, do you take some of that money off the table, or if you do, where are you putting that money, and how to address that and really still be in the market, but, address your returns and, potential future losses if we're, at a peak here and heading back down south, and I think that's the big issue. Now, one of the things about a bear market is that that's, basically when the market has declined by 20% or more. Now, in history, what's really interesting is that anytime we've had a 50% recovery of that 20 or more percent loss, we've been in a bull market. It's continued on. It's risen. It's never hit a new low. That's a big deal.
Yeah, no, that goes back through every market cycle, going back to World War II, right? So the statistics around it suggest that if the rally that
you're quite the historian, Dan. I got to.
Well, little tip of the cap to UMass there. But, if the rally, hits a third of the way up, but then falters, it's going to fail, right? History tells us that the market will in fact drop again and likely reach a new low. So the dip will go further than the previous bear market bottom. However, if that recovery period hits 50% or more, like it has, so from June 16th was the low, we're down about 25%, and we're up 17% since then, looking at the S&P 500, it's never failed to continue the rally, right, and complete the recovery, so we get back to where we were at least. But there's other indicators from the bear market perspective of what is a low that we've yet to hit. So the question, going back to, I think, part of Ben's conversation there just a moment ago, we tend to look at things like rising unemployment, the Federal Reserve starting to lower interest rates, not raise interest rates, a slowdown in profit estimates, and a downturn in Treasury yields. Really none of those things have happened yet. So those are all indicators of what the real low point is.
Well, I know this is boring for a lot of our listeners in that idea, but I think it's interesting because, when you really break this down, I mean, it's like, hey, the stock market's risen more than 50%. So that theoretically says we're in a bull market. Forget that. We're out of the bear. It's done. Yeah. But then you have this thing where we don't have rising unemployment. The Federal Reserve's not lowering interest rates. We do have a little bit of a slowdown in profit estimates across the board, I would say, for the most part, and but we don't have a decline in the 2-year Treasury yield. So 3 out of those things say that we're still in a bear market, and both of those scenarios, and all 4 of those items for the bear market have always been 100% true, all the time, historically. And so we have 3 of those that are just not playing into speed. I'd like to break down the rising unemployment piece, and real simple. I think that is just no longer a baseline item for this space, for the bear market space, irrelevant of where I land on this conversation. I really think you have to nix that one, because basically unemployment is based on the number of employable people between 18 and 65. But if you have 20,000 people retiring every day, the baby boomer generation, they're falling off the rolls of the government, articulating how many people want a job who are of age, So theoretically, you're reducing the number of people. It could be people that are theoretically off the employment enrollment numbers, but they still want a job. So that's kind of interesting. So you really can't see that data is no longer, because just because you might have a couple million people over 65 that want a job doesn't mean that you're going to start including that entire demographic age bracket.
Sure, they're falling out of the stats, but they're not. They haven't affected the signs in the street, right?
Exactly.
Everybody's still hiring, right? So if you want a job and you're 66, you can probably still get one.
Oh, absolutely. Right. That's something that is super common, and I'm actually surprised because there's a lot of people. There's a lot of people who are in retirement that don't want full-time 40-hour-week jobs, but there's other jobs out there that they would be very well suited for, and it's easy to do. But at the same time, they don't want to get paid $10 an hour to do it. So that's another issue. So, but it's crazy to think that we are literally going to find out this outcome probably in 6 to 12 months and figure out which of these is going to hold true. And the truth is that we could start having rising unemployment and then the market could drop. But we would have break the 50% cycle, and then it'd be like 52 or 55, right? So
move the bar again, right?
Move the bar. So those are big issues, and those are big concerns for people. And I think for a lot of our listeners, like right now, do I take my money out of the market? Is that the thing that I should be doing today? And what are you guys doing? That's the question we get. And I think the easiest way to answer that is that we use a lot of, technical fundamental management inside our passive investing. We've talked about this in the past on our show, is the idea that, we believe that the market intuitively is a good place to put your money. We think that long term the returns are there, and playing a part in the market every day is really the best focus, because if you just take a few days out of the market, your returns go from 8 to 10% averages down to 2% averages historically. So it's a few days you don't want to miss inside the market returns that make the most dramatic change. That being said, we use some triggers that really just drive various scenarios. One of them is the 200-day moving average. We use the 200-day moving average to get out of the market all the time. So anytime the average of the last 200 days is in a negative spiral, we're then moving into some form of cash or cash equivalents. We did that on our S&P holdings sometime back in April, and that was a very good move for us. The market had pulled back, but not entirely. We went to cash on a chunk of our portfolio, and then sometime in the low, mid to high 3,000s, we reinvested some of it, and that was great. We've enjoyed some returns on a portion of it. We didn't put it all in. We weren't sure if it was all the way down. And now we're here debating what we do with those returns, because some of those returns are up 10, 15%. So it's, there's some really decent recovery in this, 4,300 S&P scenario. So it's a great question. There's a lot of moving parts here, and we're debating it as much as everyone else out there. What I always tell people is taking profits is something you should never feel bad about. Enjoy the profits. Just because someone else sold it higher or it did more, there's always going to be a new opportunity to invest somewhere. And so if you feel like, hey, I really want to take some of these profits, I really don't want to endure a new low, so what if you give up another 5 or 10% return in the next, year over that? If if you're going to endure another 20% loss, is that worth it? That's really the concern people have, and I think we're going to address how to mitigate that and still be invested here as we move forward.
Yeah, and one of the things that I came across I thought was really interesting when we talk about moving averages and how is the market valued right now, but 88% of the S&P 500 stocks are above their 50-day moving average.
88%.
Yeah, so that is representative of a really strong period in the market right now. I mean, these companies have done very well with their share price in a very compressed period of time, coming off of a really steep drop. So.
The other thing is there was a ton of cash on the sidelines. So people looked at this drop as being like something of, I better get in before it gets me. I'm happy with getting somewhere near the low. A lot of people were claiming the S&P 500 was going to hit 3,500, even 3,400. Totally could have. And there was all sorts of, fundamental analysis that said that could happen. But I think a lot of people said, hey, it's 39, 36, 37. Like we were like, you know what? We're not going to get the bottom, but we're going to be pretty close to it.
Yeah.
And so we already had the cash. We're redeploying it. It's a good opportunity. I think that's really interesting. But to think that the S&P, and I know you mentioned this earlier, Dan, is that it's 17% off of its June 16th bottom. That's a big amount. That's an enormous amount of a recovery. I mean, just to think about that, we're like literally not even 2 months. I mean, the technology and the information moves so quick that I feel like if I miss a day just analyzing the market, I feel behind because there's just so much data that didn't exist 20, 30, or 50 years ago, in an amplified basis, so it's pretty interesting.
It's, it just reminded me as I'm sitting here, we're talking about the analysts that we watch on TV and, take most of that stuff with a grain of salt. But what everybody was totally convicted about was when the market was really dropping and we're spiraling towards the low in June. They said, hey, listen, maybe by year end this thing will be okay. But the one thing we won't have is that V-shaped recovery. Well, guess what, man? We got half of the V, at a really pitched angle coming right back up there.
Yeah, it's really interesting. Listening to those people and the commentators, they're all self-serving in every level. Like, if they like a stock, it's just and they're telling you, oh, I love the stock, it's all because they want to sell it. Yeah. Every time I hear them talk about a stock, it's like, yeah, just give it a few days. That thing's going to plummet. They just want to keep enough substance in that stock so they can unload everything that they're...
Milk that extra 2 points out of it today and then be gone,
Yeah, exactly. So, buyer beware when you're listening to these people. Now, I think there's a piece. We did a conversation about, forward earnings a while back and talk about the PE. One of the things here is that when we talk about forward earnings, the S&P a couple months ago was at 16. Okay, now it's at 18. That's pretty reasonably high. When the S&P multiple hits about 20, people are usually selling. So we have moved. If you just give that kind of, for people that even don't understand what these numbers mean, just seeing how quickly that thing has moved from 16 to 18, and we're just fastly approaching 20. People will be looking at, getting some cash on the table. They'll look for another opportunity to enter. And to your point, 88% of the S&P is up over its 50-day moving average.
There's still a lot of good energy companies out there with a P of 5 or 7 or less than 10.
Yeah.
And the market's back knocking on 20.
Yeah.
There's opportunity there.
There's opportunity. The lower the PE, more opportunity, in my opinion. So, hey, we're going to take a quick break. We got some solutions we're going to bring your way here on what to do next with your dollars. Don't go anywhere. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. I'd like to encourage our listeners to go to our website at BrayshawFinancial.com and go to some of our resources and go watch Sequence of Returns, a great video. We've had a lot of people enjoy that. It really adds some clarity to why combating down markets is so, so important. So don't go anywhere. We will be right back with you.
Hey folks, Seth Cressman, Brayshaw Financial Group is our company, and we bring to you Money on Tap. I say we, that's Ben and I. We have a lot of fun doing this show. And one of the things that we love about doing Money on Tap is that our goal for you to have access to the financial planning world. How do we think? What are we doing? What are we talking about? Raising the bar of your financial education. It's so critical. And that's what we're doing here. The other side of this is as well, we're financial planners. If you are looking to work with a financial planner, if you want to have that playbook for you to understand the important things right now and how you're going to get to your goals or how you're going to retire successfully, that's what we're doing as well. If you have $250,000 of investable assets, give us a call. It's free to you, and it is worth your time
to pick up that phone and give us a call and discover what complete wealth management looks like. Ben and I are excited about the opportunity to partner with you and give you that financial plan that's going to make the next step so much better understood and get you where you need to go.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw, joined here with Dan Miquelon. We're both partners and planners at Brayshaw Financial Group, and super happy to have you on the show today. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. Today we're talking about, is this a bull rally in a bear market? And there's a big fat question mark on that. We've been talking about a lot of the moving technical pieces and the different things that, are driving the questions, because there's so many opposing triggers that define one or the other that are, always have been 100% right historically, all the way back to World War II, as Dan had so graciously blessed us with his history knowledge. But there's a lot of different pieces to trying to break down this information and really try to understand what should people do. And I think the thing is that right now there's a really good opportunity to take some profits. That's personally my thinking. But that doesn't mean that you're entirely getting out of the market. So I want to spend the next, number of minutes that we have here talking about a few investment opportunities, investment strategies that people can use moving forward. Do you want to take the first one, Dan?
Yeah, I think it's a good time to be in quality, right? In PE, we just talked about the forward multiple, the market. That's a great indicator of whether a stock would be considered quality, right? So something that is paying a dividend, has got a track record. We talk about them as blue chip stocks all the time, right? So anything that is paying a reasonable yield, that has an underlying, consistent, strong share price. And what we've typically done, it kind of goes by the needs of the investor, whether you're looking to accumulate wealth or produce income. But there's two different things you can do there with these assets that spin off revenue, that spin off income to you. You can either reinvest it and use that cash to buy more, or in a time like this might be a great opportunity to actually raise some cash, right? So for all those instruments that you own inside of your investment portfolio that do pay a dividend, make sure you take a look and understand whether those dividends are being reinvested or being paid to you in cash.
Yeah, I think that's really, really important because, the one thing about collecting cash is it just gives you the ability to selectively choose when and where to deploy those dollars. If you've got a stock paying you 5% a year and you got $100,000 in it, you're getting $5,000 a year. It's sitting in cash, and all of a sudden you're like, hey, you know what? This other company's got a better dividend and they look opportunistic. Maybe I can buy into that one. That's a great opportunity. One of the ETFs that we use, and we've used regularly, I don't even know if it's deployed now, but we've used DGRO, the Dividend Grower ETF, and that's a really good opportunity to get some exposure to kind of some dividend growing assets and so forth. There's a lot of those out there. I wouldn't necessarily recommend that one over any one other, but that's not. That is reinvesting its dividends automatically. So that wouldn't accomplish that piece, and I think that's interesting. Fidelity has a couple, so there's a lot of different spaces out there that you can get some exposure to that without having to try to figure out if you're going to, pick a stock, and so forth. So, but buyer beware. A lot of these dividend stocks have really been, driven home, and I think that's where when you make the point, Dan, that you don't want to do the reinvestment. These things have really made money because people have flocked to quality in fear of the loss of the market, which is pushing the Dow up significantly in some areas. Mm-hmm. Apple being probably the biggest winner of that right now, which is interesting. And so I would just caution people to start trying, stop don't try to pick your own stocks. I mean, if you're really like, hey, I want to be in equities, I really want some blue chips. We have an entire portfolio that has made money this year, just like Warren Buffett has. We talked about earlier, net of fees, and you can get some exposure to that. And it's simple. Walk in, we can help you with that. That's a good scenario.
One other point there too is just kind of a preparation for year end. Loss harvesting. If you do have a position that is down and recovery seems like it's a long way off or not happening, period. Maybe you got kind of whipped up into some of these meme stocks or bought something kind of more on the speculative end, kind of in the height of the pandemic. It might be an opportunity to raise some cash there, right? Sell that one out, sit on the cash, potentially look for a safer redeployment of it, and just understand that you can write off some of that loss at the end of the year.
Yeah, just don't rebuy the stock within 30 days.
Yes.
So,
be out. If you're out, be out.
Yeah, you're out, be out. Be done. When you're done with a stock, be done with it. And if you come back to it 6 months later, or 5 months later, or a year later, then looks like an opportunity to buy, then maybe you do. Trying to trade a stock around itself, there's nobody listening to this show that's going to be qualified enough to really be able to do that on their own. And that would be something I would never advise anyone. Two other investment scenarios. One of them's in the ETF space, and there's no particular provider or company or whatever, but there's the buffered ETF space, which we talked about, some of the buffered annuities, and we'll chat a little bit about that again. But the buffered ETF space is kind of interesting, where you can buy the NASDAQ, the S&P, you can buy any of these indices with a buffer to it. Yeah, I mean, it's a good way, particularly for people, and this is a scenario that we've run into a lot. So this is advice that we're given on a regular basis these days is, for people who are in their retirement accounts in particular, but any account, have, enjoyed the good high times through the beginning of the year here where the market was peaking, made some plans around those values, expecting that money to continue to be there. Like if you were ready to put your foot on top of the sailboat and push off. That's right. And maybe now
cranking you're not up the anchor.
Yeah, maybe now you're thinking twice about it.
Yeah, that's for people who were kind of at that point and really felt secure in what's ahead, and then experienced the 6 months between January and June where the rug just got pulled right out from underneath you, and we've seen people come to us in their 401ks with losses in excess of 25-30%. That was just really got hit hard in this thing. So you've kind of had that experience. You've enjoyed the bull run. You've cried your way through the bear market, and now we're at this point of, well, which direction does it go now? And you've recovered half of your loss. Well, this might be really an opportune time, quite honestly, to start looking at some of these buffered products, so that you can not exit the market entirely and forego that other 50% of the recovery that's still out there potentially for you, but at the same time, take what you've rebuilt to and put some protection around it.
Yeah. So these buffer programs, basically, they're hedging the market, and they could be a 10% buffer or 20% buffer. If you're buying one that's in an open market space, it could be anywhere between as it's moved up and down the S&P ladder. The buffer could be smaller. It probably is. It's something that was recently purchased that's for sale. If something new, they usually start off with a round number, a 10 or a 20. Mm-hmm. If they were purchased much higher and they pulled back, your buffer is going to be lower. So there's like different ways to look at these things and figure out. But it's a great opportunity to say, you know what, the market might pull back another 5 or 10%. Let me just hedge, not losing that much again. I'm happy with having made back a big chunk of this, and I'm willing to put some risk on the line, but I just want to protect some of it. And I think that's a very interesting piece and an opportunity for people to go. And it's, generally these things are fairly low fee for the most part, so there's, some of them are commission based, some are fee based. So it just depends on who you're working with and how that is. And you can ask those questions of anybody.
But it's a way to put some insurance around a segment of your portfolio to say, the full volatility of this ride is just no longer for me. Let me put some protection in place.
Yeah. In the buffered ETF space, obviously there's no real insurance, but let's get into the insurance side of the insurance, and that's the buffered annuity space, which is all the same bells and whistles and similar and so forth. A lot of people use these for tax deferral, for savings money that they've, or joint brokerage accounts kind of investment stuff. where you put your money in. You can choose your same buffers, the 10 and the 20%. Some companies have 15 and so forth. So a company will absorb the first 10, 15, or 20% loss in the market. Anything above that loss. So if you have a 10% buffer and the market goes down 15, you'd absorb personally a 5% loss. The company would absorb the first 10. I think that's a really great opportunity. But with these programs, there's obviously caps on how much you can make. So there's, anywhere from 10 to 15 to 20%, depending on the company and how you're structuring these things. This conversation is really about you. It's really about figuring out where you're trying to get your money, how you're going to grow your funds, and what is the right thing for you. There's just so many people out there looking at retirement that I honestly think that the risk of loss is greater than the risk of reward.
And for people who find themselves specifically in that particular that feeling or that mindset, there are opportunities that we have as well where we can actually guarantee you no further loss from here, period.
Yeah.
Only upside. Limited. I mean, you don't get the full exposure to the market with the 0% loss feature built in. That only makes sense, right?
Yeah.
Otherwise, we'd all be there all the time. But, if you're at that point, having had this recent experience and have just come to the conclusion, based on your own risk tolerance and your own time horizon that, there's just no more appetite for risk here at all. But you do want to do a little bit better perhaps than what the bank's offering. Opportunities exist that we can provide something for you that will do exactly that.
Yeah. I mean, there's fixed annuities, there's fixed index annuities, that's some of the stuff Dan's referring to. There's a lot of different scenarios for investing that just the average layman is not getting in the market. And if, I use the illustration all the time that if people just have all their money in the stock market, it's like building your house on the sand. It's just, you have no foundation, you have no, you have to have solid assets that you can rely on in case of an emergency, a scenario. You're in retirement. You can't just have the market drop 40%. I mentioned the video in our resources tab. It's called Sequence of Returns at BrayshawFinancial.com. Go to our website. Watch that video. It is unbelievable if you just look at the sequence of returns between two different people, same investment, starting different time periods, how dramatic the difference can be, because sequence of returns is so, so important and drives really everything that keeps a portfolio in retirement alive. You're listening to Money on Tap. I'm Ben Brayshaw, joined here with Dan Michelon. We're partners and planners at Brayshaw Financial. You can reach us at 855-226-8551, and you can be assured that I probably say that number in my sleep and don't realize it. But you can also email us at info@yourmoneyontap.com. So what do you do now? What's the final advice, Ben? Dan and I have been talking about this, and we believe that if you're not raising cash right now, you're probably going to be, potentially putting yourself out for more liability of loss than you are of any potential gain.
Yeah, I think this recovery from the low has been nice, but I think volatility continues to be there, will exist for some time, but I think some real opportunities are on the horizon, and it's a good time to get positioned for that.
Yeah, and I think there's always a new opportunity to buy. So even if you're selling some S&P assets or NASDAQ assets or whatever, you're taking some profits, just enjoying profits and being satisfied that you made money from any sort of period of time. And if you're selling at a loss but the market's recovered, having cash on the sidelines at all times and always encouraging yourself to take profits. Don't ever get so tied up with a stock or an asset or an investment that you're not willing to part with it because you have this emotional connection to it. That is the most dangerous thing out there. And what I would tell you is that, having cash on the sidelines, maybe you take it out of the S&P, but you're redeploying it somewhere else at some other location. That's something you can get some advice and help from a professional on. But I truly believe that, opportunities will be coming, and I think there'll be, more to be had. And if you sell the S&P and it's not there and it's at 4,600 in 3 months, well, great. We may have gotten out and gotten back in, by that point in time.
People are a lot happier, in my experience, having missed 5% of a rally versus having lost 5%, on the downside. It's just a different emotional feeling entirely.
Yeah. And you know what? When you have the cash on the sidelines, you get to deploy it and make some money on the other end. Nothing will make you happier. And so, that's our advice today. Cash is king, and, cha-ching, ching, right? Dan, I guess that's the best rhyme I could come up with today. Thanks for listening. We'll be with you next week. Appreciate that. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. You have questions about portfolios, management, things like that. You want to do some planning, give us a buzz. And don't forget to check out Sequence of Returns on BrayshawFinancial.com. Under Resources, check out that video. It's a couple minutes. It's super great, and you're gonna learn a lot. You make it a great week.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.